Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 10 of what is now going to be my 11-part video series on Roth IRA conversions. This video is all about making your estimated tax payments so we can be sure that you are on the safe harbor method and that you don't get dinged with unnecessary tax penalties. There has been a lot of interest in this topic recently, in particular because we are currently in a high interest rate environment in the United States, at least relative to recent history. And so what is the balancing act that you need to consider when calculating your estimated tax payments in a high interest rate environment? Well, on the one hand, if you pay too little, then you are going to get dinged with what the IRS calls underpayment penalty. On the other hand, if you pay too much, then your money is missing the opportunity to earn at a minimum the risk-free rate of return, which is like 3 to 5% on cash right now. Now, taking a step back into history just for a moment, there was a very long time in relatively recent history when the risk-free rate of return on cash was basically like zero. In an environment where the risk-free rate of return is close to zero, the opportunity cost of paying too much in on your estimated tax payments is significantly less of a consideration. Because yes, while it's true you don't want to give the government your money too early just because nobody likes the government, the opportunity cost to you from the perspective of generating a risk-free rate of return on the money was significantly minimized when the risk-free return was like zero. Now, I understand that even in a low interest rate environment, you could make the argument that, well, I could put my money into the stock market or into some other form of investment and earn a return on it there, so why would I want to pay it into the government too fast? And yes, I understand that you can go after a return in exchange for risk. That is what you would be doing if you put this money into the stock market or some other form of investment that required risk in order to generate a return. But then you are risking the money that you need to pay your estimated tax payments in an investment where the risk may not work in your favor. And then if you lose the money you need to pay your estimated tax payments in such an investment, then you're down on the investment and you're going to get dinged on your estimated tax payments, assuming that you can't pay them because you lost the money in the investment, and that is sort of a double whammy that you don't want. In this case, I'm not talking about taking on risk in exchange for a return. We are in an environment where you can get a risk-free rate of return of 3 to 5%, and therefore the opportunity cost to pay in too much money too fast to the government is much higher. And so to summarize, if you pay in too much too early, you are basically letting the government earn on your family's money while they give you nothing in return. So why would you do that? Why would you pay in too much when we are in a high interest rate environment? And the answer is that you wouldn't. The rational investor wouldn't. So we don't want to pay in too little and we don't want to pay in too much. We want to pay in just the right amount. And we can do that using the safe harbor method, and that's what we're going to do examples of in this video. By the way, if you enjoy this video, please like and subscribe, and let me know in the comments what questions you have regarding personal tax planning for 2025. Okay, let's go over the basics of the safe harbor method for making your estimated tax payments. So we have two options. Option option number 1 is that you base your current year estimated tax payments on information related to the prior year. Specifically, the basic safe harbor is that your current year estimated tax payments are based on 100% of the prior year's tax. As an example, if your total prior year tax was $10,000, then your total safe harbor estimated payments for the current year would have to equal $10,000. Now, option number 2 over here is basing your safe harbor estimated tax payments on current year's information. Specifically, the total safe harbor estimated tax payments have to equal 90% of the current year's tax. For example, if your current year's tax was estimated to be $10,000, then your safe harbor estimated tax payments would have to equal 90% of $10,000 or $9,000. Also important to note that if we're back over here in option 1, there is an AGI threshold that causes the amount you have to pay to increase to 110% of the prior year's tax. This is still option 1 based on prior year's information. In fact, both of these right here are based on the same number. Continuing the example from before, if your prior year tax was $10,000, then it's $10,000 for both of these two options right here. The only difference relates to what your AGI was in the prior year. If your AGI was under $150,000, then you would base your safe harbor estimated payments on 100% of the $10,000 of prior year tax. And if your prior year AGI was over $150,000, then you would base your safe harbor estimated payments on 110% of the prior year's $10,000 of tax. They're still both based on the prior year's $10,000 of tax. It's just 100% or 110% depending on your prior year's AGI. Now, option 1 over here is what I am going to call the safest of the two safe harbor options. And option number 2 over here, this option is safe, but sometimes it's not quite as safe as option 1. Now, why is that? Why is option 1 the safest of the two safe harbors, whereas option 2 over here is still safe, but sometimes it's not quite as safe as option 1? Well, the answer is that because option 1 is based on prior year information, and prior year information is known and fixed and finalized, then your calculations are based on a known and fixed and finalized number. Over here in option 2, you are basing your calculations on a number that is not known, fixed, and finalized. You're basing it on current year's information, and that information is technically not final until you file your tax return next year. So if your income and expense information that's ultimately going to appear on your tax return changes throughout the year, it's possible that the amount of payment you thought was safe for one of the earlier quarters, let's say like Q1 or Q2, may not end up being enough if your income significantly changes in later quarters like Q3 and Q4 and you weren't expecting it earlier in the year. So just to summarize, this is the safest of the two safe harbors because it is based on prior year information. This option over here could be a little bit less safe because of the fact that this information is not finalized yet while you are calculating the estimated payments. Now, with both options, this is the part that gets a lot of people confused. It's not just the grand total of 90% or 100% or the 110% that is due. It's that 25% of the safe harbor total is due by a certain time throughout the year. And those relevant due dates, as you know, are April 15th, June 15th, September 15th, and January 15th of the subsequent year. Keep in mind mind that if any of these dates fall on a weekend or a holiday, the due date will be pushed out to the next business day. But just generally speaking, these are the due dates when your estimated tax payments are due. Let's go ahead and jump into some examples. All right, so you go to your prior year tax return. Let's assume that in this case it is 2024. There's the 2024 Form 1040 individual tax return. We're going to go right down here to page 2. There's the total tax right there on line 24. And you see that the total prior year tax was $47,892. And pop quiz question number 1 is, what is your total safe harbor for 2025 under option 1? Remember, option 1 is the prior year method. And the answer is, well, we don't know yet, Justin, because we haven't checked prior year's AGI. Ah, very good. That was a layup. Even the guys in the back row got that one. So now let's go back to the prior year tax return. Again, in this case, it's 2024, and look at AGI. So now looking here at line 11, there is AGI. We see that the number is 121,587. And so the question again is, what's your total safe harbor for 2025 under option 1, the prior year method? And the answer is $47,892. The same $47,892 that we saw up here on the prior year tax return. And why is that? Why is the answer $47,892? Because if we are using the prior year method, which we're calling option 1, and the prior year AGI is less than $150,000, then the 100% of prior year tax is the applicable safe harbor. Okay, but what if the AGI shown on line 11 of the prior year tax return was $167,448? What's your total safe harbor for 2025 under option 1, the prior year method, in this case? And the answer is $47,892 times 1.1, which is 110%, equals $52,681. And again, why is the answer $52,681? Because if we are using the prior year method option 1 and the prior year AGI is more than 150,000, then the 110% of prior year tax is the applicable safe harbor. Okay, now let's see who the smarties are in the class. Assuming we're using the example above where we've determined that the total safe harbor for 2025 is $52,681, what is the amount you have to pay for your Q2 2025 estimated tax payment? And the answer is, it depends. Okay, very good. And what does it depend on? Well, it depends on how much you have paid in already. So in order to put all of those pieces together, let's go to the estimated payments calculator. All right, so we're here in the Safe Harbor estimated tax calculator. And first we're going to enter the current year, which I'm going to say is 2025 for this example. That would make 2024 the prior year. In the next section here for AGI and tax entry, first I'm going to enter the prior year AGI. This is actual off of the tax return, just like we saw before. We're going to use this example where AGI was $167,448. So that's the number that's going to go right here. Then on the next line, enter prior year total tax. Again, this is actual per your tax return. Recall in this previous example, it was $47,892. And so we're going to put the $47,892 right there. On the next line here, we're going to enter our current year total tax, and this is a projected number, not an actual number. For purposes of this first payments calculator example, just assume that I have projected this number somewhere else, and then I have brought it back over here and put it into this payments calculator. In this first example that we're doing with the safe harbor calculation, the safe harbor is going to end up being based on the prior year. In other words, it's going to be based on this number right here. So we don't need to talk any further about where this number comes from until we get to this payments calculator number 2 example over here. So we will talk more about this number a little bit further into the video. Okay, now the next item we need to know about is your withholding for the current year, and that's going to be a projected number as well. We're going to talk about some methods to determine what your estimated withholding will be in this tab right over here in a few minutes. So let's just assume for the moment that we have estimated our current year withholding, in other words, our 2025 withholding, to be $19,200. And again, we'll get into the details of where that number comes from in just a little bit. By the way, on this calculator, if the cell is highlighted in green, that indicates a field for data entry. And so all 4 of these numbers right here are going to be items that you have to go somewhere else and either grab or calculate so that they can be used appropriately within the estimated tax payments calculator. You can think of these numbers in green basically like your source data. You have to get this source data and put it in here so that we can calculate your estimates appropriately. Okay, so now that we have these inputs, let's go to the next section, which is the calculation of the safe harbor. Right here in the first line, we have the 100% or 110% of prior year calculation. That was option 1. If I double click on this cell right here, you can see that the formula is saying if this number right here, which is prior year AGI, if that is greater than or equal to $150,000, then take cell C9 times 110%. C9 is the prior year's tax right here. And then the last argument of the formula says if AGI was not above 150,000, then just take last year's tax. Don't multiply it by 110%. And so the result in this case is 52,681 because AGI was greater than $150,000. And if you recall, we already calculated the 52,681 back over here in the first example. So that completes the first test to determine what our safe harbor is for 2025. Okay, then down here in the second row of this section, we have the 90% of current year calculation. If I click on this cell right here, you can see it's taking the current year tax projection and it's multiplying it by 90%. So if we were to use the 90% of current year option, the required safe harbor would be 66,683. And then the final row of the calculation is just the minimum needed. And the minimum that you need to achieve the safe harbor is just going to be the smaller of these two numbers. So in this case, it's 52,681, and as I mentioned, that is based on the prior year numbers. So for purposes of the rest of the calculation over here, we're going to be basing it on 52,681 or basing it on the prior year. And again, we will get to basing it on the current year over here in the payments calculator number 2. Okay, so now that we have determined what our safe harbor is for the entire year, we then need to determine what it is by quarter. And that's a very straightforward calculation. If I double click on this cell, you can see that it's just the total safe harbor for the year right here multiplied by 25%. In other words, 25% of the total safe harbor will be due each quarter. Now let's be very clear right here. These numbers do not necessarily reflect the payment you actually have to make. These numbers represent the total that needs to be paid in. Maybe you have paid some of it in already, and that could occur in the form of withholding. It could occur in the form of an estimated payment that you made in a prior quarter which was more than the necessary amount, and therefore the excess would carry over to the next quarter. It could come in the form of an overpayment from the prior year's tax return. All of those possibilities we're going to explore right down here in this next section. But putting aside for the moment what has already been paid in, these are the total amounts due under the safe harbor each quarter. Okay, coming down to the next section right here on the first line, this is the prior year overpayment applied. So if, for example, on your 2024 tax return or whatever the prior year tax return is, you had an overpayment, you would have several options. One of them would be to refund the overpayment to yourself. Another one would be to apply the overpayment to the subsequent year. In this example, the subsequent year would be 2025. So let's assume for this example that we chose to apply some or all of the overpayment from 2024 to 2025, and the amount that we chose to apply was $4,352. This item right here again is source data that you would have to get off of your prior year tax return. Okay, so going to the next line, we have withholding right here, and withholding is an item that by default the IRS will treat as occurring on a pro-rata basis. And what that means in simple terms is they will treat it as occurring evenly throughout the year. That is the default. Whether or not the withholding actually occurs evenly throughout the year is not relevant for the default treatment. For example, if you do a Roth IRA conversion like in Q1 of the year, and let's say there's withholding associated with it, that withholding in actuality is not occurring evenly throughout the year. It is occurring in Q1 when it was withheld related to the Roth conversion. But regardless of what actually happened, the IRS will treat it by default as occurring evenly throughout the year. Note there are elections you can make with respect to withholding to get out of the default assumption and have the IRS treat it as occurring when it actually occurred. That is something we can talk about later. For this example, we're going to stick with the default treatment, and therefore what we're going to do in this row, if I double click on this cell right here, you can see that is taking the $19,200 of withholding that we have projected for the year, and it's simply multiplying it by 25%. Because again, by default, the IRS will assume that it's just distributed evenly throughout the year. And when we're talking about evenly throughout the year, we're talking about the 4 quarters. So it's 25% per quarter is how they will treat it. Okay, so going to the next line, the quarterly over or underpayment carryover is something that will only be applicable to Q2 through Q4, so we're going to skip that for the moment. We will come back to that in just a few minutes. Let's now go to the total before estimated payment, which in this case is going to be $9,152. Now let's make sure we understand how this number is calculated. If I double click on this cell, you can see it's taking the sum of the prior year overpayment applied, plus the withholding that is applicable to that quarter, plus any quarterly carryover which is not applicable to Q1. So basically in this first quarter, in this example, it's just these two numbers right here. That is the amount that we already have paid in for Q1. So one more more time, this payment that is carrying over from the prior year's tax return, that will apply to Q1, and then 25% of our withholding will apply to Q1, giving us a grand total paid in so far of $9,152. And then on the next line, we're going to have the estimated payment due. In this case, if I double click on this cell, you can see it's the total amount that we are required to have paid in of $13,170, and we're subtracting off the amount that we actually have paid in, $9,152, and that leaves a remaining estimate due for Q1 of $4,018. Now right down here on the next line, actual estimated payment made, this is going to be another data entry field, and you have to type in the amount that you actually paid. This is the amount we calculated that was due in order to reach the safe harbor payment up here. But I can tell you in practice that even though this may be the amount calculated, a lot of folks tend to pay in something that seems to be pretty much anything except the number that was calculated right here. Sometimes they like to round up to the nearest $100. Sometimes they like to round up to the nearest $1,000. Sometimes they don't have enough money and they only pay in some portion of what was calculated. Sometimes they just forget and go to the beach and don't pay in anything. Just because this was the amount due does not mean it's the amount that people actually pay. So once you actually remit your payment to the government, whether you mail in a check or you do it online or whatever, for this calculator to work, you need to come over here and actually type in what you actually paid. If it equals this number, great, you are right on track. But if not, then we have functionality built in right here to the calculator to deal with the possibility that this amount of actual payment may not equal that. And that functionality starts in this next row, quarterly under or overpayment. Right now, the over or underpayment is 0 because of the fact that this number is the same as this number. But let me change this number to, let's say, $5,000. If I change this to $5,000, what are we expecting here? An overpayment or an underpayment? And the answer is going to be an overpayment. If I pay more than this, then I will have an overpayment for the quarter, and that amount of overpayment will apply to the next quarter. So I'm going to go in here, I'm going to change this number to 5,000, I'm going to hit enter, and now you can see we have an overpayment. By the way, overpayment in this row is designated to be a negative number, and the amount of overpayment we have is $982. All right, now moving forward to Q2, the amount due, the required estimated tax to be paid in to be covered by the safe harbor is the same, $13,170. But what we actually have paid in might be different. The first thing is that the prior year overpayment applied is only going to be applicable to Q1 if there is excess, like if this overpayment applied was, let's say, like $50,000, just as an example. It was way more than what we actually had to pay in as identified up here. Then that excess would carry through all the way here, and it would end up in this row right here where we currently have 982. We can test that in just a minute. For the moment, let's just walk through what we have in the Q2 column so far. So it's $13,170 is the amount that actually has to be paid in by the Q2 deadline of June 15th. We have $4,800 already paid in the form of withholding. That is the pro-rata allocation. We have $982 paid in, and that is the amount of the overpayment that is coming from Q1. Because just by changing this number to 5,000, we actually paid in more than what was required right here of the $4,018, this $982 will apply to Q2, and that's why it carries up right here to this cell. And so again, if I double click on this one, that is the sum of all of these above it. And then if I double click on this one, this estimate due is the total amount that we need to have paid in by Q2, less these amounts right here that we already have paid in for Q2, resulting in a required Q2 payment of $7,389. You'll notice that right down here at the moment, I have an underpayment as designated by a positive number in this row of $7,389. And why is that? Because currently we don't have any actual payment typed in right here. So the calculator is assuming that you went to the beach and forgot to make your payment. Therefore, you have an underpayment for the quarter right here. All right, let's quickly go back and test the scenario where I said the carryover from the prior year was going to be like $50,000. So the first thing is, let me just take out this payment. We'll just put in 0 right there. Then I'm going to go into this cell and I'm going to put in $50,000. Okay, so let's think about what is happening right here. For Q1, I'm required to have $13,170 paid in. I actually have paid in $50,000 carrying over from the prior year, plus another $4,800 of withholding. That's $54,800. So my estimate due is negative. If the estimate due is negative, that would just mean 0. You don't have to pay in any estimate. But I don't want to zero this out because I want it ultimately to carry forward and apply to the next quarter. Follow what I'm saying there? I have $54,800 paid in. I have basically used up, quote unquote, $13,170 of it to cover my safe harbor. That left me with $41,630 that I'm now going to take over to Q2 and apply it over there. So in Q2, this is still the amount due. That hasn't changed. I still have my withholding. I have my carryover overpayment from the previous quarter. My total paid in is $46,430. I only have to pay in $13,170. So in this case, I'm overpaid again now by $33,259. And then that same process of this overpayment carrying to Q3 would continue. We would be overpaid in Q3 by $24,889. That would carry to Q4, and ultimately we would be overpaid for the year by $16,519. Now let's do a quick side calculation to make sure that everybody is understanding what this $16,519 represents. Let's put aside the quarterly issue. Let's not worry about the quarterly payments for this side calculation. Let's just do it in the aggregate. So right here, if I have $50,000 of carryover payment from the prior year, and I add to that $19,200 of withholding for the year, and I sum those two up, it's $69,200. $69,200 is the amount I have paid in for the year, ignoring the breakout by quarter. The safe harbor that I actually need is right here, $52,681. And so if I take the total amount that I have paid in right here and subtract off the safe harbor that I actually need, what is going to be the result right there? And the answer is $16,519. That is the excess of what I have paid in over what I need, resulting in an overpayment. And up here on this line, just remember that overpayments here are designated as negative numbers. And of course, in practice, it's usually not going to be as obvious and straightforward as you have a huge carryover payment right here, and that amount plus your withholding covers everything, and so you never need to make any estimated tax payments. Usually it's going to be something more like this, where you have a small overpayment, you have a variety of withholding, and ultimately there will be estimated tax payments calculated, and like I said, a lot of people will end up paying something other than what the actual calculated amount is, and so you need to be able to factor in in all of those variables in the calculation. Okay, picking up where we left off earlier, you had gone to the beach, remember, and you had forgotten to make this payment. Therefore, we had an underpayment of $7,389 for Q2. Now, assuming that you had this exact situation right here and the Q2 deadline has passed, the question is, are you gonna get dinged? And the answer is yes. If you have an underpayment for the quarter, which is what we have right here, you are going to get dinged. The extent to which you get dinged will be based on both the amount outstanding, in other words, the amount of underpayment, and also how long it is outstanding for. The interest and penalties on these underpayments are calculated on a daily basis. So if you miss making your payment by June 15th and then you say, oh, dang it, I was at the beach and I'm going to go ahead and pay this $7,389 in by like June 20th, then once you get to June 20th, the calculation of interest and penalties will stop and you're only going to be dinged for like 5 days of time. But if you just ignore this completely and you let it sit here outstanding until next year when you file your tax return, then the ding is going to be much larger. But let's just assume for this example that you did forget to make this payment right here. You just totally spaced it, whatever, and then you didn't figure out that you forgot to make it until you got to your Q3 calculation. Okay, so for Q3, the safe harbor that we are required to pay in is still $13,170, no change there. We still have our $4,800 of withholding allocation, no change there. But now what do we have on this line right here? We have the $7,389, which was an underpayment in Q2. That is carrying up here and being included in this total right there. And so then when we calculate the estimate due right here, which is the total amount required to be paid in, less what we already have paid in, we're actually getting a number which is larger than the required amount of safe harbor payment. So let's think about how to interpret this number. We have the $4,800 paid in already, but we are short from the prior quarter by $7,389. So when you add these two together, we are still short by $2,589 from the prior quarter. So if I need to pay in $13,170, but I'm also short from the prior quarter of $2,589, that means I would need to pay in $15,759 in order to get caught up. In other words, in order to get caught up on a cumulative basis, cumulative meaning Q1, Q2, Q3, the sum of these three is the total that I need to have paid in by Q3. So in order to get caught up on that cumulative basis, I need to make this payment right here. Let's assume that we do that. I'm going to go here and type in $15,759 and I'm going to hit enter. Now let's think about this. Let's do another side calculation. Can we show that we are caught up on a cumulative basis with what we are required to be paid in by Q3 by making this payment right here? Let's try that. So right here in this side calculation cell, I'm going to start by summing up the three amounts for the first 3 quarters that need to be paid in by Q3. That total is $39,511. The next item I'm going to put in my list right here is the $4,352 of overpayment from the prior year. The next thing I'm going to put in my list right here is the sum of the withholding for the first 3 quarters. The next thing I'm going to put in my list right here is the $5,000 estimated payment that was made in Q1. And the final thing I'm going to put in my list right here is this $15,759, which is the catch-up payment that we just talked about. So now I'm going to type in the sum formula right here. I'm going to sum up these 5 numbers right there. I'm going to hit close parenthesis, and before I hit enter, what is your expectation of the sum of these 5 numbers? Well, hopefully it's going to be 0. Are you following that calculation? This is the total amount cumulatively that we need to have paid in through Q3. That's the overpayment from the prior year. That is the withholding year to date. That is what we paid in Q1. That is what we determined we needed to pay in Q3. And the sum of all of those equals 39,511, which would mean if the sum of everything we have paid in equals the amount we are required to have paid in through Q3, then we are caught up. And so this plus all of this right here equals 0. Okay, now pop quiz. Does catching up like we just did right here, now we're fully caught up, does that eliminate getting dinged from interest and penalties in this example? And the answer is no, it does not eliminate getting dinged from interest and penalties. You had an underpayment right here, and this underpayment was outstanding for 3 months, right? From June 15th through September 15th, you didn't do anything about this payment. It was just outstanding. And so even though you caught up right here, you're still gonna get a 3-month ding on this underpayment. Now, it's still good to catch up. You want to catch up because by catching up, you have now cut off the calculation of interest and penalties. You have now cut off getting dinged from this point forward. But there's nothing you can do about these 3 months right here. This 3-month period is over. That ding that you're going to get right there, there's nothing that can be done once you fix it in Q3. The only thing fixing it in Q3 does is stop it from accumulating even more. Okay, so finishing up the example for Q4, let's say we did make this catch-up payment right here, so now we're on track. We go to Q4, we still owe another $13,170 in order to remain on the safe harbor. We have $4,800 of withholding, no change there. This time we have no overpayment or underpayment carrying forward from the prior quarter because we had already cleared up anything right here. We also didn't overpay, so this is 0 right there. That gives us a grand total of $4,800 paid in, and so if I double click on this, that's simply the $13,170 that we have to pay, less the $4,800 that's already paid in, leaving $8,370 due. And if I go down here and let's just say that I actually pay in the $8,370, then we would be fully paid in with nothing else due, and we would be covered on the safe harbor, but for that 3-month period where you're going to get a ding right here for that underpayment. Now, one more side calculation, ignoring the quarterly issue. Let's just look at it in total. Here is the safe harbor that is required, $52,681. There is my carryover from the prior year, $4,352. There's my grand total withholding for the 4 quarters of $19,200. Right here, if I double click on this, there is the sum of all of the payments, the 3 payments that I actually made during the year. That total is $29,129. Okay, and one more time, if I sum up this number, this, and this, what is the total of those going to be? And I would expect it to be 0. Follow? This is what we had to pay in on the safe harbor, and these are basically the 3 types of payments that could be made. One is an overpayment from the prior year, one is withholding, and one is estimated tax payments, and the sum of those equals what we were required to pay in under the safe harbor. So while this would put you on the safe harbor for the year, you still did not complete the safe harbor estimates, not all of them anyway, by the required due date, and therefore you have a 3-month ding related to Q2. If we go back here real quick and we just change some of these around, let's say we actually make the 7,389 payment that was due. Now we have 0 right here, so we are not underpaid. We will no longer be subject to a ding. If we go back over here, we are only required now to pay in $8,370. So if I change this to $8,370, $8,370. Then we have 0 here, so we won't be subject to a ding there. That leaves $8,370 due for Q4. If we actually pay it in, we'll be at 0. Let's do the side calc one last time. This number is the sum of everything we had to pay in. This number right here is the overpayment from the prior year. This number right here is the sum of all the withholding for the year. This number right here is the sum of all the estimated tax payments for the year. And then the sum of all 4 of those numbers is going to be 0, because what we were required to pay in is equal to everything that we have paid in. And in this case, because we have no underpayments in any of the 4 quarters, then we will be covered completely under the safe harbor, and we will not be subject to any underpayment penalties. All right, so that completes the first payments calculator example when the safe harbor was based on the prior year. Now, we previously talked about where on your tax return to find these 2 numbers right here, prior year AGI and prior year total tax. So the next 2 items I want to talk about are where to get this item right here, your withholding for the current year, and then also where to get this item, prior year overpayment applied. All right, first up, how do you calculate estimated withholding for the current year? Now we're going to go through a couple of options. Option number 1, if you expect your withholding to be relatively consistent with the prior year, then the first thing you can do is go to your W-2 from the prior year, go to box 2 here, the federal income tax withheld, and then project the 2025 amount or the current year's amount by increasing the prior year's tax withheld at the same percentage as your expected increase in wages. For example, if you expect a 5% increase in wages, then multiply the prior year's amount, in other words, the prior year's withholding, by 1.05 to get a current year estimate. Now, option number 2, what if you expect your withholding to be somewhat different than the prior year? Maybe you changed employers, maybe you went from part-time to full-time, or vice versa. There could be a variety of reasons why the withholding on your prior year's W-2 is not really applicable to the current year anymore. So in a situation like that, another possibility is identify your federal withholding from a recent pay stub, for example. So like right here is an example employee earnings statement. Here is the section for the current pay period. And then right here you can identify the federal income tax withheld. When you're doing this, make sure to understand what the period that applies to the withholding is. For example, when it says this period right here, is it referring to weekly pay or bi-monthly pay or something else? And then whatever time period we determine that to be, multiply the withholding by the number of periods that would constitute 1 year. So for example, if you receive weekly pay, then you would multiply the federal withholding by 52. If you receive bi-monthly pay, then you would multiply the federal withholding by 26. So assuming you are expecting consistent employment with relatively consistent pay for the year, then this method should provide you with a reasonable estimate to use for your estimated tax purposes. All right, option number 3, what if your 2024 withholding wasn't from employment? For example, maybe it was from a 1099 div or another 1099 form. You could potentially have federal income tax withheld here. If this was not a 1099 div, but perhaps a 1099R from doing a Roth IRA conversion, there would be a box equivalent to this where there could be federal income tax withheld on the conversion. So there are a number of possibilities as to how you might use this information. For example, you could use the prior year amount as an estimate for the current year if you are expecting similar brokerage activity in the current year. In other words, if you're trading or you're transactions or your other brokerage activity is expected to be similar and you're expecting the same amount of withholding, you could use the prior year number as an estimate for the current year. However, this situation where withholding is not from employment, this can also be an example of where withholding in the prior year may not really be applicable to the current year and should not be used for estimate purposes. So continuing on the thought process of the 1099-R, let's say that this was a 1099-R. Let's say that in 2024 you actually did not do a Roth IRA conversion, but you did one in 2025 already. Let's say you did one in Q1 of 2025, and let's say you had withholding on that Roth conversion. The broker withheld money on your behalf and remitted it to the government. Just making up a number, let's just say that the amount of withholding was $10,000. Now, if that was the only Roth IRA conversion you were planning to do in 2025, then for estimate purposes, I would just use $10,000. So going back to the payments calculator for a moment, let's say that you are retired, you don't have any withholding from a W-2, and your only withholding related to 2025 so far was from the Roth conversion you did in Q1. There was $10,000 of withholding on it. If that was the only Roth IRA conversion you were expecting for 2025, I would put $10,000 right here. If you were expecting to do another Roth conversion in 2025, and if you were expecting to have withholding related to it, then you would have to estimate the amount of withholding on that second Roth IRA conversion, which perhaps hasn't actually occurred yet, and you would put the combination of those numbers in this cell right here. So just continuing with that thought process, if the second Roth IRA conversion you were planning to do, let's say, was about the same amount as the first one, and therefore you were expecting about the same amount of withholding, then you would have about $10,000 from the first conversion and $10,000 from the second conversion, and you would put $20,000 right here. Alternatively, let's say that the second conversion you were thinking now would be double the amount of the first conversion. If you were expecting withholding on that one, then it would probably be expected to be about double the first conversion. So the first conversion was $10,000, you'd probably be expecting about $20,000 on the second conversion, and so that grand total of $30,000 is what you would put right here. And so when it comes to option 3 here, where you have withholding that is transaction specific as opposed to withholding from like a W-2 position, then you're going to have to use your best judgment to determine if the prior year's amount would make an appropriate estimate for the current year, or if the current year's activity is going to be different enough that you're just going to have to estimate your withholding based on whatever transactions you've completed already, like a Roth conversion in the first quarter, plus whatever transactions you are still expecting for the remainder of the year. And you're going to have to come up with an estimate of what you think that withholding will be for the full year based on your best judgment. And then finally, the last item I want to talk about on this tab is to find your overpayment from a prior year that is carrying forward to the current year. Go to your prior year tax return and find the line that says amount applied to your 2025 estimated tax, and that is right down here on line 36, amount you want applied to your 2025 estimated tax. And of course, if you're doing this calculation in 2025 or beyond, then this number could say 2026, 2027, or whatever the subsequent year is. So in this example, let's just say we look right here on line 36, we see that it's $4,352, and that is where the $4,352 over here on the calculator would come from. Okay, moving to example 2. Now, what if you want to use the safe harbor method option 2, i.e. the 90% of current year tax option? Where on last year's tax return do you go to find the number that you need to use? And hopefully Hopefully some of you may have noticed the little sign right over here that this is a trick question. You can't go to last year's tax return to find this year's tax. Remember, the safe harbor is 90% of the current year's tax, i.e. 2025 in this example. Okay, but I haven't filed my 2025 tax return yet. In fact, my 2025 tax return isn't due until April the 15th, 2026. So how am I going to determine a Q2 2025 estimated tax payment due on June 15th, 2025, or this question could be applicable to any of the quarters, based on the total tax due for 2025 when my tax return won't be done until April 15th, 2026? Ah, great question. The answer is you have to prepare an estimate of what your 2025 taxes are going to be, and you have to do that in 2025 before the year is complete if you want to base your estimated tax payments on 90% of 2025 tax. Okay, so how do I prepare an estimate of what my 2025 tax is going to be? Well, what do you think the personal tax planning template is? Well, let's take a look inside of the personal tax planning template for a moment here. Let's take a look in this column right here. What is this? What does this column represent? This is an estimate of what your taxes are going to be for 2025. That's what we're preparing inside of the personal tax planning template. Here is your ordinary income section. We have our W-2s, interest, dividends, Roth conversions, pensions, Social Security, all of the items that constitute your ordinary income. Then down here in this section, we have your long-term capital gain income. We have the long-term capital gains themselves. We have capital gain distributions. We have qualified dividends. Further down on the list, we have all of your other kinds of income and adjustments, such as business income, rental income, HSA contributions. Then we get down here to the section where we determine if you're going to take the standard deduction or you're going to itemize deductions. Further down the list here, this is all of our tax rates and tax brackets. There's the projection of tax that you have to calculate in order to make your estimated taxes based on 90% of the current year. Going further down, we have our long-term capital gain tax calculation. We have our self-employment tax calculation. We have our net investment income tax calculation. We have our tax credits section. And ultimately down here, we have our total tax. This column right here is the projection of your 2025 estimated income taxes. So if our projected tax for 2025 is $74,092 in this example, by the way, did you see where the $74,092 came from in the personal tax planning template? Right here. This is the grand total tax, including all of your ordinary income tax, long-term capital gain tax, net investment income tax, self-employment tax, and so on. This is the grand total right here. Total tax for the 2025 projection. That $74,092 is the number that we saw right here in the payments calculator earlier, where I said we projected this somewhere else and we would go over where that came from later on. That's where the number comes from. It comes from your projection of 2025, and that's what we're doing inside of the personal tax planning template. Projecting our estimated taxes inside the personal tax planning template is not just for doing Roth IRA conversions, it's also for calculating your quarterly estimated tax payments. It's also for everything in tax and financial planning where you need an estimate or projection of what your future income taxes are going to look like. Projecting your income and taxes for future years inside of the personal tax planning template is the foundation for all of your individual tax planning, whether it's Roth IRA conversions, determining your quarterly estimated tax payments, or any other tax strategy. People love to say, I'm going to do some tax planning. Oh, that's great. So what is your effective tax rate right now? They don't know. They have no idea what their effective tax rate is. How are you going to do any tax planning if you don't know what your effective tax rate is to start? Said more simply, how are you going to get from point A to point B if you don't know where point A is in the first place? The answer is you're probably not. You might talk about tax planning, you might think about tax planning, but you're really not doing anything until you lay out your numbers and figure out where point A is, until you figure out the impact of your strategies on your effective tax rate. So with that in mind, let's move to payments calculator number 2. Okay, so starting up here at the top, these are the same years as we had before, so we know about that. This is the $74,092 of projected total tax expense for the current year, which we just went over, so we know what that is. This withholding of $19,200 is the same as the previous example, so no change there. Where we are going to have a change right here is in these two rows, the prior year AGI and the prior year total tax. In this case, I'm going to just change the numbers to be what you see here. We'll just assume that you got these off of your prior year tax return, just like we went over in the previous example. Your prior year tax return just happens to be different than the numbers that we previously used. And so now we have a situation where the actual per return from the prior year is $97,000, but our projected tax for the current year is only $74,000, as we saw in the personal tax planning template. So this time, when we get down here to the safe harbor calculation, you can see that 110% of the prior year, remember it's going to be 110% because this number is still greater than 150. So that safe harbor based on the prior year is going to be $107,672. But right here, if we base it on 90% of the current year, if I double click on this cell, you can see that's 90% of the 74,092. That safe harbor is only 66,683. And so again, when we get to the next line, which is just the lesser of the two, the minimum needed of these two safe harbors, the required minimum amount is going to be the 66,683. Now think about these results right here from the opportunity cost perspective that we talked about at the beginning of the video. If you base the safe harbor on last year, you're sending in almost $108,000 to the government over the course of the year, when you really only need to send in $67,000. That's about a $40,000, $41,000 difference. So that's $40,000 that you could have sitting at the risk-free rate of return for the entire year, basically, compounding interest in your favor with no risk, as opposed to just sending that money into the government for which you will receive no return. And the key thing I want you to notice right here is, when does the 90% of current year safe harbor generally become more beneficial to you? And usually, if we look right back up here, it's when your current year tax projection is lower than your prior year. If we go back over here for a moment to payments calculator example number 1, the current year in this example was significantly larger than the prior year, and that's why the prior year ended up being the lower safe harbor. This would be an example where your income and thus your tax is projected to be greater in the current year than it was in the prior year. But going back over here to payments calculator number 2, this would be an example where your current year income and tax is projected to go down relative to the prior year. And that is the general situation where the 90% of current year safe harbor tends to become more beneficial. But remember that even though the 90% of current year safe harbor is more beneficial, you want to make sure that your estimates are as accurate as they can be, and you're going to want to review them each quarter, because this number right here is still based on the current year, and the current year can change. It's not final until the year is over. So that is something to keep in mind if you're going to base your estimated payments on 90% of the current year. Now, going over here, we don't need to belabor this calculation again because it's going to work exactly the same way as in the previous example. The one difference I want to point out, if I double click on this cell right here, you can see it's still taking the minimum needed safe harbor and multiplying it by 25%. It just happens to be based on the current year's estimate instead of based on the prior year like in the prior example. This number right here, the prior year overpayment applied, is the same regardless of whether we're basing the safe harbor on the current year or the prior year. This number just comes off of your prior year tax return. In this example, the withholding is going to be the same, and then everything else from this point down is just a calculation other than this row right here, which is just where you type in the payments that you actually made. By the way, if you'd like to check your current safe harbor status and determine your quarterly estimated tax payments using the newly revised safe harbor method calculator that you have seen me demonstrating throughout this video, the calculator is included with your purchase of the personal tax planning template program that you have seen me utilize throughout this currently 10-part Roth IRA conversion video series. Using the safe harbor method calculator will help you gain confidence that your estimated tax payments are calculated appropriately and that you are sufficiently paid in by the quarterly due dates to avoid getting dinged with underpayment penalties. So if you're already a member of the personal tax planning template program, you can just log in and download the safe harbor method calculator at your convenience. And if you're not already a member, the personal tax planning template program is available for purchase at the link in the description below this video. Your purchase helps out the channel and provides you with a tax planning and analysis tool set that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. So if you're interested in that, the purchase link for the personal tax planning template program is available in the description below this video on YouTube. In addition, the next quarterly estimated tax payment due date is right around the corner. If you would like additional help figuring out what your estimates need to be for the upcoming quarter as well as for the remainder of the year, I have just released my all-new estimated taxes advanced training. This is the most advanced and comprehensive training on calculating estimated taxes that I have ever made available. We are going to cover what if you started the tax year basing your estimates on the prior year tax, but then your current year projection suddenly changes. What if you started the tax year basing your estimates on the current year tax, but then your current year projection suddenly changes? How do you change from the prior year safe harbor method to the current year safe harbor method mid-year due to a change in facts and circumstances? How do you start calculating your estimated taxes mid-year when you weren't calculating them at the beginning of the year? How do you know where you're at regarding the safe harbor at any given point in time throughout the year? What if you had uneven income like Roth conversions or capital gain harvesting at the beginning of the year? How do you calculate your estimated taxes for the rest of the year? What if you're planning for uneven income like Roth conversions or capital gain harvesting at the end of the year? How do you adjust your estimates now to account for the additional income? What if some of your uneven transactions had withholding on them and some of them didn't? How do you incorporate transactional withholding into your estimates calculation? How do you utilize the election to treat withholding as occurring when it actually occurred within your estimates calculations? What if you know you're underpaid in Q1, Q2, or Q3? What strategies can be utilized in Q4 to remedy the situation after the fact? What is the difference between the Safe Harbor method and the annualized income installment method, and how do you compare the two in order to decide which one is best for you. This training is for anyone who wants to become fully comfortable with determining their estimated taxes and safe harbor status at any given point in time throughout the year. It's for anyone who wants to proactively avoid getting dinged with underpayment penalties, and it's for anyone who wants to understand the advanced strategies that are available to remedy dings in a prior quarter if they were not previously keeping up with their estimated taxes. This advanced training is available for purchase at the link in the description below this video. Getting hit with tax penalties is one of the silliest reasons to pay too much into the government over the course of your life, and it's also one of the simplest things to learn to avoid. Both the monetary cost of it as well as those pesky IRS notices that come in the mail every time you underpay your estimated taxes. So if you're interested in taking complete control over your quarterly tax obligations, hop into the Estimated Taxes Advanced training at the link in the description below this video. So that's going to be it for this part 10 of the Roth IRA conversion video series. I hope you enjoyed today's video. Thanks for watching, and I will see you in part 11.